Hey guys, what is going on? Welcome into the video. So we've had a huge rally in the market over the last few weeks, and in this video we're going to talk about what is next for the market and how to trade it, along with some scenarios and some individual trade ideas to watch out for moving forward. And as always, there are timestamps in the description for any part of the video you want to skip to. Now let's go ahead and get on into it. So starting out, taking a look at the big picture of the S&P 500, we've been talking about these two key trend lines shown by the arrows for a while now, and a couple weeks ago we finally got the breakout. And we talked about as long as this breakout holds, there is no real bear case for the market. We ran through a bear case of the breakout failing and this bull case of the breakout holding, which pretty much played out to a T so far and ran up all the way near 4,500. So this was a massive breakout and a parabolic move for the market. And now the question is what comes next? So let's take a look at a few important charts. So on the S&P daily chart, where this rally topped out so far was on Thursday with a daily RSI of about 79. So this is the most overbought that the S&P has been since September of 2020, signaling that this trend badly needs to cool off. Call volume on the S&P just hit an all-time high with 1.8 million contracts traded in a single day, and this is a euphoria signal. Along with this, the fear and greed index is now flashing extreme greed. So all of these indicators are telling us the same thing. The recent trend has been very strong and the market is now bullish, but we are now reaching a point of euphoria, which is when pullbacks and corrections do take place. What this current move reminds me of is two instances back in June of 2020 and September of 2020. So the market had a strong trend, but had these exhaustive moves where the market went up too much too fast, and following instances like this is when pullbacks and those corrections take place. June had an 8% pullback and September had a 10.5% pullback. So in my opinion, something like that is coming for the S&P and NASDAQ. So for my ideal base case scenarios, I'd be watching this 417.7 to 423 zone on the S&P, which is where it previously broke out of above. A retest of support would be more than healthy, give the market a much needed cool off, and build up energy again for a potential move higher where something like this could play out. And for the NASDAQ, this is even more of a clean setup. The 329.8 to 334.3 zone was where this broke out of. It is even more extended than the S&P and is testing a key resistance at 372. Also, if you notice, this has built out a great looking cup pattern. This would be an awesome scenario if we got that violent pullback and retest of the previous breakout zone, and it would build a multi-year cup and handle pattern and be really explosive if the market is going to follow through with a leg higher. Now keep in mind, this is just my opinion and it won't play out perfectly like this. Maybe the pullback doesn't go this far, maybe the market goes higher before the pullback starts, etc. But overall, as long as the S&P and NASDAQ hold these key zones, my lean will be bullish for the bigger picture for the indexes. I personally have big fundamental concerns based on where valuations and multiples are trading at compared to above 5% rates. Of course, this is not the zero rate environment we had back in 2020 and 2021, but more than anything, I'm a technical based trader and a trend follower. The goal isn't to be right, the goal is just to make money, and the easiest way to do so is to follow the technical trend. Now, like I've said, we need a sizable pullback for risk reward to be favorable for these indexes, but after that will be the time to be more aggressive in my personal opinion. But human emotion and patterns never change in the stock market. Right now, the market has had a massive run up and the majority are saying stocks can't go down and new all-time highs are coming. A violent pullback will usually follow with those emotions, and once we're near the bottom of the pullback, you're going to hear everybody saying new low soon and sell all your stocks, and that will probably be the time to be buying to get ready for that next potential leg higher. This market pattern and human emotions happens time and time again. For more on this, let's take a look at Tesla stock. So this stock had many parabolic moves, and history always repeats itself how these moves resolve. There is always a 3-month consolidation at the minimum, and usually a 20 to 30% pullback even when it's in a bull market. Ask yourself this question: would you rather buy at current prices? And sure, the stock could continue to run and go higher, but the pullback and consolidation phase will start anytime now. Or would you rather buy after the pullback? With this, you can set tight risk below a key support level. Also, the trend has cooled off, it is no longer overbought, and it can set up for a leg higher if it wants to after that. You're also risking 2% for a potential reward of 20% plus entering on a pullback. If you buy at current prices, you're looking for something like 5% upside max versus potential downside of 20%. This is what separates a trader and a gambler. The trader always has odds and favorable risk reward on his side. Alright, so now let's shift gears to a few setups that I'm bullish on right now. So recently we talked about the Russell 2000 small cap index, ticker symbol IWM, breaking out of this 3-month consolidation. It followed through nicely and hit the key resistance on the upside at the 188 to 190 zone. This looks to be setting up for a leg higher soon for a few reasons. Number one is it's trading very cheaply compared to historical multiples. Small caps are trading for a forward PE of 13.5, mid caps are trading for a forward PE of 13.7, and large caps are trading for a forward PE of 19. So these small and mid caps have a lot of catching up to do if the market is going to stay bullish. And also if you look at this chart, historically small and mid caps have traded for more expensive multiples than large caps did. Alright, so getting back to the chart and running through some key patterns and scenarios we could see next. So the key levels that I'm watching on this is 188 to 190 as the current key resistance, and then supports at 185, 183.5, and then the 180 to 180.5 breakout zone. So as long as it holds above that 180 to 180.5 zone, the breakout is intact and my lean stays bullish on this. Some key patterns to watch is number one, this wedge that is formed with higher lows and lower highs. Once patterns like this break, there's usually an explosive move that follows. And number two is this key long-term trend line that has acted as resistance since the beginning of 2022 and just rejected again. Let's run through some scenarios now of how this could see a leg higher following this move. Starting out, we could see just a simple breakout out of this bull flag above the trend line in the 188 to 190 zone, which starts the leg higher. Or maybe we see some more consolidation, a back test of around 183.5, which was the previous gap acting as new support, and then continue higher from there. Or something like this where it sees a more violent pullback. Maybe the S&P and NASDAQ are seeing a violent pullback and this follows those initially but is able to hold the breakout back test in 180 to 180.5. This would be a must hold level if retested, and if so, a great risk reward setup to enter on a bounce off of with a tight stop loss back below. So now let's take a look at a few individual stock setups. We're going to start out with EOS Energy, ticker symbol EOSE. So this is a battery and energy storage company and it's formed this great looking 1+ year long base and inverse head and shoulders pattern and is currently testing a neckline and breakout level at 3.3. Breaking and holding above there starts the breakout and leg higher with the next potential levels and targets above at 4, 4.98, 7.4, 8.8, and 10.10. This is also a name that has a little over a 30% short float. Squeeze plays like this have been targeted recently, and this has that great technical setup to go along with it. Another technical setup that I'm watching right now is Rivian, ticker symbol RIVN. This also has a similar bottoming base look to EOS with an inverse head and shoulders pattern built out. So the neckline of this pattern is at 15.7 where breaking and holding above there starts upside and levels / targets above are at the 18.5 gap fill, and then 19.95, 22.1, and 22.4 next above there. Something to note though is on Friday this had a false breakout above 15.7 on heavy volume, which tells me that this is likely to see another pullback before attempting to break out again. So a scenario like this is what I'm watching for to put another slight higher low before pushing out of this base, and that would also form a volatility contraction pattern or VCP, which are notorious for explosive moves on breakouts. So that is everything that I'm watching for in the week ahead. In my opinion, the S&P and NASDAQ badly needed pullback, but we'll see if we get the start of that this coming week. Hope you all enjoyed and hope I provided some value to you in this one. If so, make sure to hit the like button and subscribe button down below. Helps me out a lot and I would greatly appreciate it. For anybody interested in joining the private Discord chat, that is the first link down in the description. You get my personal trade alerts, nightly watch lists, and you can ask me any questions there. I'll catch you all next time. Good luck trading this week and peace out.